we now look at portfolios. A portfolio is not one asset, but a set of assets. So instead of investing in one asset, when you invest in a set of assets, your investments form a portfolio. For example, you may invest in IBM, AT&T, and Ford. Now this will create a portfolio with 3 components. Now your entire investment is going to have a return, and if the components are variable, that entire return will also be variable. So a portfolio has an expected return and variance, just like an individual stock. Just like an individual asset, a portfolio will also have a variable return, and the variable return means that today you can have an expected return, and the actual return which you're going to get today, you're going to look at it and say, okay, it has this variance. The return to the portfolio, the actual return to a portfolio, or the expected return, is the sum of returns to individual stocks weighted by the portfolio stocks weight. And weight here means like what fraction of the portfolio has been invested in a particular stock. For example, if you invest half your money in IBM, a quarter in AT&T, and a quarter in Ford, then the weight for IBM would be 0.5, the weight for AT&T would be 0.25, and the weight for Ford would be 0.25. And the return to the portfolio will be 0.5 multiplied by IBM return plus 0.25 multiplied by AT&T return and 0.25 multiplied by Ford return. So when you combine these different stocks into the portfolio, as I just said, the return to the portfolio is the weighted returns of the individual components, and the standard deviation is the weight of the first component square. Now this is for a simple case where there are only 2 components in a portfolio. Then it will be the weight of the first component square into the variance of the first component plus the weight of the second component square into the variance of the second component plus twice into the weight of the first into weight of the second into standard deviation of first into standard deviation of second into the correlation coefficient between the first and the second. Now what does the correlation coefficient actually do? It measures how much whether the stocks move together in the same direction or they move in opposite direction. Now if the assets move independently of each other, then the correlation coefficient is 0. So like one is like moving this way, the other is moving that way, there's no relationship between the two, and then you say the correlation coefficient is 0. And if, however, like when one moves up, the other also has a tendency to move up, and when it moves down, the other has a tendency to move down, then you say the correlation coefficient is positive. And what you see from this formula is if the correlation coefficient is positive, then this is a positive amount which would increase the standard deviation. Now this and this are not affected by the correlation, so these are just affected by individual standard deviations. However, and the weights in the portfolio. However, this is the component which measures the impact of whether the two move together or move separately. If the correlation coefficient is negative, what does that mean? Well, it means that when one moves up, the other has a tendency to move down, and when this one moves down, the other has a tendency to move up. Now, if you have 2 such stocks in a portfolio with negative correlation, what do you expect would happen? Well, the move of this would cancel out the move of this, and vice versa. So you can see when you sum these, you weight them and sum them, because they have a negative correlation. When one is moving in one direction, the other is moving in the other direction, it would have an effect, the correlation would have an effect of reducing the variability of the sum, of the weighted sum, because the moves are kind of cancelling each other out. And if that is so, the standard deviation for the portfolio, the variability of the return of the portfolio is going to fall. And that is what also this formula is telling you. If the correlation coefficient is negative, then this component is going to have a negative effect and it will reduce the standard deviation. Now, asset has variability, and so we say that it's risky. Now we can divide that riskiness into two kinds of riskiness, and we call them systematic risk and unsystematic risk. Now, what is systematic risk? Now, systematic risk is a risk which arises due to economy-wide reasons. For example, if the economy is in recession, that has a particular impact on a stock. And that impact leads to systematic risk. Now, when an economy, like, when there's an economy-wide reason, it'll affect many stocks. So it'll tend to move their stocks in a direction which is related to the economy's move. It could be a positive move or a negative move. However, then you'll see that this is causing all stocks to move at the same time. Some of them may be moving up, some of them may be moving down. However, the reason behind these moves are the economy-wide reason. And this is going to lead to a correlation of an individual asset with the entire market, with how the entire market is doing. The entire market moves due to economy-wide reasons. It does not move due to how one particular stock does. It moves due to economy-wide reasons. And the systematic risk part of a stock's riskiness is going to make it correlated with the moves of the entire market. And so higher the correlation of movements of the stock with the market, higher is its systematic risk. Now, most of the time, systematic risk is positive. That is, when let's say the market moves up, the impact on most stocks is that those stocks will also move up. However, for a few stocks, it could actually be negative. And gold is supposed to be one such asset which moves in the opposite direction to the market index. So gold actually provides insurance for stock market investing because it moves in the opposite direction to the market. So when the market moves down, the gold is supposed to move up. So after systematic risk, we are going to look at next unsystematic risk. So the measure of systematic risk is called beta. And that's a word you'll hear a lot in finance. Now, beta is defined as, for an asset A, is defined as the covariance between the asset and the market. So you can measure covariance by looking at deviations and kind of following a process similar to that when you calculate standard deviation. So you calculate covariance between the market and the asset, and you divide that by the variance of the market. And here, Rm, which is the return to the market, and that's what you're measuring the covariance of the asset with. Now, unsystematic risk is the risk due to firm-specific factors. So this is just risk which is something which affects only one firm at a time. It doesn't affect other firms. For example, has the firm discovered something new? Has it found a new drug? Or have the management been cooking the books? And so these kind of things will affect only one firm at a time, and it'll cause like variability, which is not related to rest of the market. And what happens is that this kind of risk, the impact of it, you can get rid of by diversification. So this is a very basic idea in modern asset pricing finance theory that diversification gets you rid of one part of risk, which is unsystematic risk. Therefore, it's a good thing. You don't want to be holding on to any risk if you can get rid of it, because risk is bad. Risk is something which makes asset prices go lower because people don't like it. And lower asset prices means that there is higher expected return. So to convince people to hold risky assets, they must be offered lower prices, which is the same as higher returns. So that is kind of one of the ideas behind CAPM, that risk is bad, people need to be compensated for risk, and also the idea that unsystematic risk can be got rid of by diversification. And assuming diversification is costless, there are no transaction costs or anything like that, then if unsystematic risk can be got rid of without any cost, then there should not be any compensation for holding it. I would take on unsystematic risk because it won't have an impact on my portfolio, because the asset has such a small part of my portfolio that the unsystematic risk vanishes. And that's the idea behind CAPM. So unsystematic risk can be diversified away, and therefore investors will not receive any extra return for bearing unsystematic risk. So a stock return with zero beta, which means that, what is the stock return with zero beta? Well, beta was a measure of systematic risk. So stock return with zero beta will be a stock with no risk or only unsystematic risk. So such a stock, according to CAPM, the CAPM ideas, will have a zero risk premium. Because even though the stock may have risk, it is entirely unsystematic risk, which does not earn a premium, which does not earn a higher return. Therefore, a stock with zero beta, which means the same as saying zero systematic risk, will earn no risk premium, will have a zero risk premium. Here are some other facts. The expected return on the risk-free asset is called the risk-free rate. And by convention, this is usually the T-bill rate. So the T-bill is a short-term government bond and a short-term US government debt. And because it is US government, so you can say there's no default risk. And because it is short-term, there's no interest rate risk either. Because when interest rates move, the prices of bonds change. So because it's short-term, the effect of interest rate changes is going to be minimal. So the short-term rate is taken to be the T-bill rate. The market portfolio is the most diversified portfolio possible because it has everything in the market. The market portfolio is like everything in the world. It includes all stocks available. Due to the very large diversification of the market portfolio, it has only systematic risk and no unsystematic risk. So the market portfolio has only systematic risk. So the larger is the correlation of a stock with the market portfolio, larger is its beta, and for the stock A we call that beta A. So we represent the beta of stock A as beta A, and therefore the greater the systematic risk borne by investors who purchase stock A. And this risk they cannot get rid of by just diversification, because this is the risk due to economy-wide reasons. This is the risk which makes everything move together. So diversification doesn't help here. Now these investors are compensated by higher expected return to stock A, as they are bearing risk which cannot be easily diversified, or which cannot be diversified. So we now come to the world famous CAPM. It's short for Capital Asset Pricing Model. A CAPM is a simple model. It has only two periods. So in the first period, people buy assets, and in the second period, they get payoffs for these assets, which you can take as prices of the assets in the second period. And these assets, so if they have different payoffs, how are you going to find the prices today? Well, you're going to look at the payoffs, expected payoffs, and you're going to divide by 1 plus D, where D is the discount rate. And what CAPM does is that it basically tells you why the discount rate should be different for different assets. It'll, for example, say for a riskless asset, the discount rate should be, let's say, the riskless rate R. And then for a risky asset, it should be larger. However, only systematic risk matters, because unsystematic risk can be diversified away. So, and what is, how does one find systematic risk, the amount of systematic risk? Well, for that, you have to look at the correlations. How is an asset correlated with the rest of the assets, with the rest of the market? And so CAPM is a theory of discount rates based on correlations. Now, putting together the ideas that we have been talking about, we have a formula for discount rates, or the rate of return, which are the same, one and the same thing. The expected rate of return for the asset A, according to CAPM, is the risk-free rate plus a measure of the systematic risk for that asset, which is beta A, multiplied by some risk premium. And CAPM actually goes on and tells you exactly what this risk premium is. So here what you have is that the return to an asset is a basic risk-free rate, which is just like simple, which is simple compensation for waiting to consume, plus another part which is due to the risk that the investor is bearing, and that part is proportional to the beta for that asset multiplied by the risk premium. So now we would like to find the risk premium. So beta multiplied by the risk premium gives you the extra amount which the stock will earn over the risk-free rate R. Now we know that the market portfolio is perfectly correlated with itself. An asset is perfectly correlated with itself. An asset, if an asset moves up, asset A moves up, so does asset A. If it moves down, so does asset A. So an asset is perfectly correlated with itself. So the market portfolio is perfectly correlated with itself. And you stick that into the beta formula, what you get is that the correlation for the market portfolio, it's perfectly correlated, and that will lead to beta for the market to be equal to 1. And you take that, so you're looking at the return to the market, you put that into the CAPM equation, it'll tell you that the return to the market equal to the risk-free rate plus 1 plus beta of the market multiplied by the risk premium, or this tells you that the risk premium is equal to RM minus RF. So now we come to the CAPM equation again, but now we have got rid of risk premium. We are putting in an exact amount for it, and that exact amount is RM minus RF. So basically the CAPM equation says that the expected return to an asset A equal to the risk-free rate plus beta for that asset multiplied by RM minus RF. So here's a quick check of the CAPM equation. We check if it actually gives you the right expected return for the risk-free asset. Well, a risk-free, what is a risk-free asset? A risk-free asset always has the same payoff. So it has a constant payoff, whereas the market moves up and down. So what's the correlation between something which is constant and something which is moving up and down? It's 0. There's like no movement together or no movement against. So if the correlation is 0, its beta is 0. So you put in beta equal to 0 into the CAPM equation, and what you have then is that the expected return is RF, which is what you would expect for the risk-free asset. So as a revision, I'm going to go over the logic of CAPM. I'm going to go through the different steps. Now, the very initial idea is that people dislike risk. And what do we see in the real world which kind of says, yeah, this is correct, this is the right idea? Well, people buy insurance. And that enables them to get rid of risk, and for that they pay a price. Now, the second idea is that investors will trade off risk for higher expected returns. So what that means is that assets which have risk, which people dislike, will have a lower price today. And the lower price today is the same as saying they will have a higher expected return. Because what is, after all, expected return? It is the amount you expect to get divided by the investment that you make today. And the investment that you make today is the price you pay to purchase the asset. So if the price today is lower, that is equivalent to the expected return being greater. Video check thing. Now, different people have different levels of risk aversion. It could depend on their personal taste. It could depend on where they are in their life cycle. If they're closer to retirement, they may not want to take on risk. If they are younger, they may say, okay, over a longer time horizon, I think I'm okay taking some risk. So depending on the amount of risk aversion that they have, they will choose different portfolios. Investors with low risk aversion will choose more risky portfolios. And because they will get higher expected returns. And investors who have a very high risk aversion will choose less risky portfolios. So back to the different kinds of risk. And there is unsystematic risk and there is systematic risk. Now, unsystematic risk you can get rid of by combining many different assets in a portfolio, so by diversifying. If you actually look at the standard deviation equation for a portfolio, you'll see that the individual deviation is multiplied by weight square. Now, that's where actually the diversification comes from, the benefit, because let's say you have 1,000 of a portfolio invested in one asset. When you put that into the standard deviation of the portfolio equation, that 1 by 1,000 gets squared, so it becomes 1 by 1,000,000. So you can see the impact of that reduces because of the squaring which you get for standard deviation. And that's just the mathematical way to look at it. Intuitively, you can see that if there are many different assets all kind of randomly moving, then the average across them will not be moved. You don't expect it to move in any particular direction. Okay, so unsystematic risk can be got rid of by diversification. Systematic risk, which makes everything move together, cannot be got rid of by diversification. And hence, investors only care about systematic risk. And when an asset has systematic risk, the investor has to be given a higher expected return to purchase that asset. However, for unsystematic risk, because you can get rid of it by diversification, investors don't have to be given any extra reward. So they don't have to be given extra expected return. So the measure of systematic risk for an asset is called beta. And that is proportional to the correlation of that asset with the market portfolio. Market portfolio is the portfolio of assets in the economy. So it has only systematic risk, because diversification gets rid of all the idiosyncratic risk, because it's a very diversified portfolio. Beta, which is the correlation of a stock with the market portfolio, is a measure of the systematic risk of the stock. And that beta, as a measure of systematic risk of the stock, is going to be used in the CAPM equation. So greater beta, greater is the amount of systematic risk which the stock has, and therefore greater must be the expected return which investors ask for to hold the stock, to buy the stock, which is the same as saying that they pay a lower price for the stock, because the stock has some undesirable characteristics, that is, it has a lot of systematic risk. Now, a model of general equilibrium for the economy based on the above ideas is the capital asset pricing model, which basically says that the expected return to an asset A is the risk-free rate plus the beta for the asset multiplied by risk premium, and the risk premium is the return to the market minus the risk-free rate. The security market line is a plot of betas of assets against their expected returns according to CAPM. So larger betas will have larger systematic risk and therefore will have larger returns. So this is the SML. Security market line, and on this axis you're plotting beta, and on this axis you're plotting expected returns. And what you see is that for larger betas, you have larger expected returns. The same as saying that assets have lower prices today for the same payoffs. Lower prices equivalent to larger expected returns. And if the beta is 0, the return is the risk-free rate, according to CAPM again. So that's RF. So we have the beta of a portfolio. It is computed in a similar manner to expected return. So the beta of a portfolio P is simply the weighted average of the betas of the individual components of the portfolio. And this is very similar to what the return of a portfolio would be. So we are going to use the formula for the variance of the portfolio that we did earlier. And the variance of a portfolio is the square of the weight of the first asset. So the weight of the first asset is 0.3, so it should be 0.3 square, multiplied by the variance of the first asset, and the standard deviation is 0.6, so the variance would be 0.6 squared, plus the square of the weight of the second asset, and that is 0.7, multiplied by the standard deviation squared, which is the variance of the second asset. So it will be multiplied by 1.2 squared, plus twice into the weight of the first asset into the weight of the second asset. So that will be 0.3 into 0.7 into the standard deviation of the first asset into the standard deviation of the second asset. So that will be 0.6 into 1.2 multiplied by the correlation coefficient of the two assets, which is 0.2, And this turns out to be equal to 0.79848. So this is the variance of the portfolio. To find the standard deviation, you are going to take the square root of this variance, and the standard deviation sigma will equal 0.8936. Here we are going to apply the CAPM formula to find the expected return on a stock. And so we assume that CAPM is true and use that to find the expected return. The beta for the stock is 2.4, the risk-free rate is 4%, and the expected return to the market is 7%. And the question is, what is the expected return to the stock? Well, it's going to be the risk-free rate, so that's going to be 4%, plus beta, which is 2.4, multiplied by the risk premium, and the risk premium is the expected return on the market, 7%, minus the risk-free rate, 4%. So this is the expected return according to CAPM, and if you solve this, it'll be 3 into 2.4 is 7.2%, and 4 should be 11.2%. So here we have a slightly different version of the equation. Now you don't have to calculate the market risk premium, it is given to you directly. Again, we have to find the expected return, and the expected return should be again the risk-free rate, which is given as 4%, plus beta, which is 0.8, multiplied by the risk premium, that's 5%. So 0.8 into 5 is 4, 4 plus 4 is 8%. So be careful whether you are given the market risk premium or the market expected return. The market risk premium is what you multiply beta by. If you're given the market expected return, you have to subtract the risk-free rate from it to get the market risk premium. In this example, we have the risk-free rate to be 4%, expected return to a stock is 8.8%, and its beta is 0.8. And the question is, what is the market risk premium? Well, again, you will have the equation that 4% plus 0.8 into the market risk premium. So let me just call that MRP, let's say. Market risk premium into market risk premium equals 8.8%. And so you take this on this side, you get 0.8 into market risk premium equal to 4.8%, or that should give you market risk premium equal to 4.8 divided by 0.8, or that equals 6%.